Welcome to the deep dive. Today, we're really cutting through the noise to understand PACCAR's latest earnings.
Yeah.
This isn't just about the numbers, right? It's about decrypting the complex forces shaping, well, a truly vital industry.
Mm-hmm.
We're here to give you that insider's view, a shortcut to being genuinely well-informed.
Exactly.
Our mission: extract the most important nuggets of knowledge, insights from PACCAR's second quarter 2025 earnings call and their press release.
And we're going to connect those dots for you. We'll look at how the broader economy, shifting regulations, and PACCAR's specific performance all, intertwine.
Right.
The goal is really uncovering the why behind the numbers and what it means for, well, the whole transportation solutions landscape.
Absolutely. By the end of this deep dive, you'll have, I think, a much richer understanding than you'd get from just, a quick news scan.
Definitely.
We found some genuinely surprising insights, some real aha moments that make even what seems like a dense topic pretty engaging. Let's jump in.
Let's do it.
Okay, so for anyone tracking PACCAR, those Q2 numbers might raise an eyebrow a bit.
Mm-hmm.
On the surface, revenues, net income, they're down from last year. Specifically, $7.51 billion in revenues, $723.8 million net income for Q2 25.
Right.
Compare that to $8.77 billion and $1.12 billion in Q2 24. Big difference.
Yeah.
But PACCAR calls these results good. So what's the real story here? Are they just managing expectations, or is there some strategic brilliance the raw numbers don't quite reveal?
That's the crucial question, isn't it? What good means in this environment? It's not just about year-over-year growth. It's really about resilience, profitability per unit, in a softer market.
Okay.
They delivered 39,300 trucks globally in Q2. Their gross margin, 13.9%.
Uh-huh.
But they're projecting Q3, that margin could dip, maybe to around 13%. That's primarily due to, well, the uncertain tariff structure.
Yeah.
This clearly signals, an interesting time in the market. These external factors are really challenging their financials, making those good results kind of a testament to strong underlying operations, especially in certain segments.
Gotcha.
And it's worth noting, too, for the first half of 2025, their adjusted net income was $1.49 billion. That excludes a non-recurring charge in Europe, so it gives a clearer picture.
Okay, so while new truck sales face these headwinds, what are the foundational elements, the things really underpinning PACCAR's profitability, giving them that resilience? Let's start with PACCAR Parts. Their performance was, well, stellar.
Absolutely stellar, yeah.
They reported record quarterly revenues, $1.72 billion, and excellent quarterly pre-tax income, $416.5 million.
Mm-hmm.
And here's the kicker. They did all that in an overall flat parts market. So what's the secret to those incredible 30% gross margins?
Yeah, achieving 30% in a flat market, that's not just good. It's a strategic masterclass, really.
Right.
The insight isn't just what they do, but how they've engineered that parts business. It's a consistent, high-margin profit engine.
Yeah.
Well, it's not just selling parts. It's about delivering the right part to the right place at the right time. They've got this huge network, right? 20 global distribution centers.
Wow.
Over 3.9 million square feet, supporting over 2,000 DAF, Kenworth, Peterbilt locations, plus 350 TRP stores.
That's massive.
It is. And this segment, it creates what's basically an annuity stream. Reliable earnings that stabilize the whole business no matter what new truck sales are doing.
Like a foundation.
Exactly. A steady foundational profitability. They're even forecasting 4 to 6% year-over-year sales growth for Q3, partly helped by more ship days in Europe.
Okay. But it's not just parts holding things steady, is it?
No, not at all.
Another crucial piece, PACCAR Financial Services, PFS, they also posted a robust pre-tax income, $123.2 million in Q2. That's up from last year.
Yeah, and that success in PFS, it's fueled by a couple of things. Strong credit quality and improving used truck results.
Yeah, used.
Exactly. They operate a network of 13 global used truck centers. And they're opening a new one in Warsaw, Poland this year, specifically to boost used truck sales there.
Smart.
And PFS's excellent balance sheet, their A plus A1 credit ratings. That's absolutely crucial.
Why is that?
It lets them offer competitive financing to dealers, to customers across 26 countries. So PFS is another vital source of steady earnings. It complements the parts business perfectly.
Like shock absorbers, he said.
Yeah, exactly. Like incredible shock absorbers in a turbulent market. They also issued $1.84 billion in medium-term notes in the first half of 25 to support this.
Okay.
And that segment also includes pack lease, right? Full-service truck leasing, 40,000 vehicles, another consistent revenue stream.
Okay, that makes sense. Let's unpack the key market dynamics now, starting with North America. The 25 market estimate for Class 8 trucks, somewhere between 230,000 and 260,000 units.
That's the range, yeah. And Kenworth and Peterbilt, PACCAR's brands, they captured a strong 30.4% market share in the first half. Pretty solid.
Very solid. But what's influencing this market?
Well, it's definitely being influenced by several factors. You've got general economic conditions, a soft truckload market,
Right.
and then this cloud of tariff and EPA 27 policy uncertainty.
Mm.
But it's not all softness. There's actually good customer demand in less than truckload and vocational segments. Construction, too.
Infrastructure spending helping there.
Exactly. That provides a solid base, definitely.
So with those mixed signals, PACCAR still seems pretty confident about North America strengthening in the second half. What's giving them that optimism? Is it just legislation or something deeper?
It's a combination, really. A big driver is that One Big Beautiful Bill Act.
Okay.
It's expected to improve customer cash flow, enhance their, ability to deploy that cash for capital asset purchases like trucks.
So they'll have more money to spend.
Basically, yeah.
Yeah.
And this is already leading to customers starting to engage on the 2026 order season, so looking ahead.
Interesting. What else?
The other crucial factor is the upcoming 2027 emission standards. Specifically, the NOx standard nitrogen oxides, the
Yeah.
pollutant.
Right.
It's set to drop dramatically from 200 down to just 35.
Wow, that's huge.
It is. It's not a small tweak. It's a massive technological challenge, and it will definitely bring on cost to the product.
So people might buy before that hits, a pre-buy.
Exactly. That's what's expected. Encouraging pre-buys later this year and into next.
Okay. And what about inventory? PACCAR says they feel very good about their position.
They do, and they should. Their inventory is at a very lean 2.9 months of retail sales for Kenworth and Peterbilt.
And how does that compare?
It's notably lower than the industry average, which is sitting around 4.2 months.
So being leaner is better.
Strategically, yeah.
Hmm.
Minimizes holding costs, gives them flexibility, and it's important to understand roughly half of PACCAR's trucks are actually bodybuilders.
Why is that?
It reflects their leadership in the vocational segment. Those trucks often need custom bodies before final delivery. Think dump trucks, cement mixers.
Right. Adds complexity, I bet.
Oh, definitely. But they manage it really well.
Okay, let's shift gears.
Mhm.
Europe. The above 16-ton market for 25, estimated between 270,000 and 300,000 vehicles. That's considered relatively strong, right? Despite economic uncertainty.
Yeah, relatively strong is a good way to put it. And what's driving TF's strong performance there, it's their innovative aerodynamic trucks. They provide best-in-class fuel efficiency and driver comfort.
And they just updated them.
They did. The 2025 model's got a new turbo system, engine valve timing, predictive cruise control, enhanced aerodynamics, all boosting fuel efficiency by another impressive 3%.
And customers like it.
Seems so. Their market share is up year to date, so strong reception for those tech improvements.
Okay. And then South America. The estimate is 90,000 to 100,000 units for the above 16-ton market. That's a reduced outlook, isn't it?
It is, yeah, and the primary driver for that reduction is Brazil.
What's happening in Brazil?
Interest rates. They've seen 400 basis point interest rate increases just since the start of the year.
4%? Wow.
Yeah, a full 4% jump. Imagine trying to finance new trucks with that kind of hike. It really hits consumer confidence and willingness to invest. Leads to a softer market there.
Definitely understand that. Okay, so we've seen where PACCAR stands today, how they're navigating things. But what about the future? Where's the money going to ensure, long-term growth and innovation? Let's look at their strategic investments.
Good idea.
They've outlined projected capital investments, $750 to $800 million, and R&D expenses, $450 to $480 million for 2025. Where's that cash going?
It's strategically targeted. Key areas are next-generation clean diesel and alternative powertrains.
Recognizing the transition takes time.
Exactly. Also, advanced driver assistance systems, safety, efficiency, and integrated connected vehicle services for fleet management, uptime.
Right.
Plus, they're investing in their truck and engine factories, too, supporting long-term growth.
And that includes a new engine remanufacturing facility, $35 million, 50,000 square feet in Mississippi.
That's right. It's set to be operational in the first quarter of next year.
And the capacity.
Once it's fully ramped up, they anticipate remanufacturing about 5,000 engines a year. That's a crucial part of their aftermarket sustainability too.
Speaking of the future, EVs and autonomy, let's touch on that. They offer the Kenworth T680E Peterbilt 579 EV for regional seaport and the T880E Peterbilt 567 EV for vocational, all with about a 250-mile range. Now, PACCAR notes EV adoption curves are slower, and interestingly, they say EVs being more expensive is actually good for PACCAR's overall business model.
That's an interesting take, isn't it? Are they being deliberate or maybe risk falling behind?
It's definitely a calculated long-term play. They get that heavy-duty EV adoption is slower than cars.
Right.
But the higher unit cost of EVs, that means higher revenue, potentially higher profit per truck, even if volumes are lower at first. So good for the business model in that sense.
Okay. And autonomy.
Their foundational principle there is absolute safety, period.
Makes sense for big trucks. Totally. They maintain that. For now, having the driver in seems like the smartest idea, even while partners like Aurora make progress. PACCAR emphasizes full production only happens when things are fully production, validated, completed production.
So cautious but deliberate.
Exactly. Commitment to safety, reliability. They're waiting for the tech to be fully mature for heavy-duty use before going all in. It's a risk-averse, highly reliable approach.
Got it. Now, another big factor hovering over everything, that tariff and EPA 27 policy uncertainty, that really screams interesting times, doesn't it?
It absolutely does. Tariffs were certainly well present in Q2, and they expect an increased weight of impact on price versus cost in Q3.
How much impact?
They estimated a quarterly effect of around $75 million, so it's a very real, tangible financial hit from these policies.
And there's that ongoing Section 232 trade investigation on medium and heavy trucks. Remind us what that is.
Right. Section 232, it's a national security-based trade investigation. It could lead to new tariffs on imported trucks.
Okay. How does PACCAR navigate that, especially given their U.S. production?
Well, they're actually in a strong position there. Over 90% of their U.S. delivered trucks are produced in our American factories.
Oh, wow.
Yeah. They believe that's good for the country. And they think clarification on these policies could enhance market clarity and ultimately benefit PACCAR and our customers.
So less exposure to import tariffs could even be an advantage.
It could be, yeah, if tariffs hit competitors harder. They also mentioned they're actively talking with customers about tariff surcharges, potential price changes, managing the uncertainty.
Okay. So as we kind of wrap up the core discussion here, looking ahead, beyond the current fog, how confident is PACCAR feeling?
They definitely express optimism for the latter part of the year and especially for 2026.
Why 26 specifically?
Largely driven by that anticipated clarity, regulatory standards, tariff structures. Hopefully things settle down. Plus, they point to pent-up demand for the future. Trucks are running, and freight ton miles are not low. So fleets will need replacing eventually. And what's really telling, I think, is how they compare current performance to past cycles.
How so?
Q2 25 profits, even with similar delivery numbers to past periods, are significantly higher than they used to achieve back then. They recalled a time, for instance, with about 38,000 deliveries, much lower revenue and profit than now. It just illustrates how they're structurally stronger today.
Because of parts and PFS and efficiencies?
Exactly. Diversified revenue, operational improvements, it all adds up.
Okay, so let's recap the essential takeaways from this deep dive. PACCAR delivered resilient Q2 results, driven a lot by the strong profitability of parts and financial services, those crucial stabilizers.
Absolutely.
They're making strategic long-term investments in future tech, advanced manufacturing, and they maintain a hopeful outlook despite current uncertainties around tariffs, the economy.
Yeah, cautious optimism.
Understanding these nuances, that's what makes you truly well-informed in this complex industry, right?
That's the goal. And this deep dive into PACCAR, it really reveals a crucial lesson, I think. How a company finds strength, finds growth, even in a dynamic industry. Their strategy, diversification, that relentless customer support through parts and finance, and consistent long-term investment in innovation and manufacturing, it's about building a robust foundation, one that can weather different cycles, turn headwinds into opportunities.
Right, a strong foundation. Okay, so here's a final thought for you, our listener, to mull over. As global markets keep shifting and new tech emerges, what role do you think policy clarity, or maybe the lack of it, will play in shaping future profitability and innovation in industries like heavy-duty trucking? Something to think about.